Now, before we get started, let's cover our usual housekeeping. I wanted to make sure that you all are properly set up with your GoToWebinar application. You should be able to hear me now. If not, there are a few steps on the screen that you can check, particularly your volume. Make sure your headphones are plugged in or your volume is turned up on your computer. The Windows sound setting can help you debug problems, as well as the GoToWebinar application, which has a nice sound wizard that can help you with audio problems that you might be experiencing. The webinar is presented today to you on a viewing and hearing only basis, so you don't need a microphone. If the sound or graphics are choppy at any point during the presentation, I suggest that you turn off any unnecessary programs that might be running on your computer, because that can interfere with the transmission of the video and audio program. You can always listen using the telephone if you need to. We suggest that you don't use a Wi-Fi connection, because that's going to be much slower. And if you have any problems at all, go ahead and contact GoToWebinar directly for customer support on their toll-free number or on their website, where they're standing by to help you with any problems you might be having. At any point today, you can use the questions box there in the GoToWebinar application to type in your questions, and I'll do my best to monitor those questions and answer them as I can. We'll have some periodic breaks during the presentation where we'll specifically ask for your questions and address them at that point. There is a handout for today's presentation. You can grab that in the GoToWebinar application. Look for the handout tab and then click on the little PDF icon, and that is there for you to save, to print quickly if you want to make notes. You can review it later on, and we'll make that available when we archive the webinar, so you will have a chance to grab it then if you don't get it during today's presentation. So before we get started, one more thing. I just wanted to introduce myself. I know many of you, and you've probably heard me and seen me in my other webinars or presentations, but I am the president of iClub Central Incorporated. We are a wholly owned subsidiary of the Better Investing nonprofit investor education organization. I am also the editor-in-chief of our two stock newsletters, the Investor Advisory Service and the SmallCap Informer. Now, iClub Central, as the name implies, makes software for investment clubs, primarily investment club accounting and operations, but we also make software and web tools for individual investors. So our focus is on long-term fundamental growth stock investing, and all the tools we make are designed to help investors to evaluate opportunities in the market, take action, and manage their portfolio. Now, I've written 6 books, including The Armchair Millionaire and the Investment Clubs for Dummies and The Complete Idiot's Guide to Online Investing, and I frequently speak at conferences. I just got back from the San Francisco Money Show. I'll be at the AAII National Convention in Orlando in November, as well as many Better Investing and AAII chapter events around the country. So it's my great pleasure to be here today to talk specifically about our SmallCap Informer newsletter for you as subscribers. So let's go ahead and take a look at what's new with the SmallCap Informer website. We have some new features and functionality that we've recently launched there that you're probably not aware of. So I wanted to go over what we've got going on the website. Hopefully these are tools that will make the website and your subscription more valuable to you. First, we have a new responsive design. So that makes the site available to cell phones, tablets, widescreen monitors in a much more attractive and useful way. We have a new stock screener that allows you to screen through the database of SmallCap Informer covered stocks. We have a new company profile page for all of our currently tracked businesses, and we have a sortable company data table that can be printed in any number of ways. So that gives you a little more access to the information beyond what's in the printed issue. So let me just talk about these one at a time. By responsive design, we mean that the website now automatically resizes all of the fonts, the graphics, the images, and the layout so that it will fit mobile devices, tablets, iPads, iPods, iPhones, widescreen monitors. So wherever now you are accessing the website, you don't have to scrunch down or zoom in on the text. The text resizes to make it legible no matter what the device you're using to access the website. Now, some features like a PDF are still not going to be readable on a small display, but the rest of the website is accessible, and so you can quickly check in as you need to when you're on the go. Here's a little illustration, and you can test this in your browser. In fact, if you hold down the Control key while you're on the website and then scroll with your the scroll wheel on your mouse, you can expand and shrink the page accordingly, and you'll see that the layout changes. On the left side here, you'll see what is what is displayed on an iPhone or a mobile phone with a vertical orientation, and you can see that the menus, instead of being tabs across the top, are now displayed in this little cheeseburger, what we call a cheeseburger or a hamburger, these little stacked bars on the right side of this screen. So you can see these. Here, I'll get my arrow here so that you can see what I'm talking about. These, what we call the hamburger, and if you click on these, they actually display the menu. So the top is the main menu, then we have the subscribers menu, and then we have the issue menu so that you can access the issue. On the right side over here, we have what you would see on a computer monitor or a widescreen monitor, and you can see here the menu goes across the top, the subscribers menu goes down the side and on the left side, and then the issue menu goes down the right side over here. So those are all compressed so that you can have maximum space on the mobile screen over here to actually read content. Fonts get bigger so that you don't have to squint and scroll so much, and so it makes it much more accessible. So this is a new feature. In fact, Google is requiring websites to adopt responsive design in that if a website is not responsive and does not resize and allow itself to be displayed on many different types of devices, Google will lower the search ranking of that website. So beyond that, it's just a nice, useful feature. We have this on our Investor Advisory Service website right now, and we'll be working on implementing it throughout our other web tools to make them accessible as well. So it's a neat feature. It's all behind the scenes, and you might not have noticed, but if you do grab your mobile phone and check out the SmallCap Informer website, you'll see instantly how well it works. Now, our stock screener allows you as subscribers to search the database of currently covered companies. We're using the data in the data table of all covered stocks that's in each issue to allow you to eliminate stocks that you might not be interested in and focus on those that have the best prospects. And you can search for any combination of factors that are on that data table. So to access the screener, click on the new screener link in the left subscribers menu after you log in. So you'll see we added that screener link below the archives link, above the customer support and the My Account page. So that screener link is updated with the publication of each issue, so the data is updated at that time. So here's what the screener looks like. We've got just some basic criteria right now pulled out of that the data table. At some point, we may consider expanding this. If you think that would be useful, let me know what you might like to see. So again, the idea is just to whittle down the list of 40 or 50 companies that we're covering to focus on those in a particular industry or particular growth rates or total return prospects. So you can enter your criteria, click the Find Stocks button, and you'll see the results page that looks something like this. So as you go across, just like as you might expect, you can click on any of these column headers at the top to resort the table. So you can sort by PE or projected earnings growth or projected total return, for instance. You can sort by industry or alphabetically by symbol or by company. And then there's also a print button that we've added up here, so you can print out the results and save them, or use them, save them for later, make notes, etc. Do additional research. There's a search field here as well to search the results, so you could, instead of isolating or scrolling through the entire list of results, you could jump quickly to a particular company that you might be looking for a little more specifically and see how it stacks up compared to the other companies on the list. So this screener, again, with 45 companies, it's not the most odious task to research within that universe, but this is just a nice little feature that's relying on the data that we've already are publishing, and will perhaps help you if you're looking for opportunities and you want to make sure you can get the stocks that best fit your criteria. This is the same data that's in the Excel spreadsheet. But if you didn't want to download the Excel spreadsheet, or you didn't have Excel, this is one way that you can access that information. So as I mentioned, click on header to sort it. And then also, if you click on the linked company name, you can open the new company profile page for that company. So now all of the companies have this profile page. And at the top, again, we have current metrics on the business, the industry, the last recommended date. And you'll notice that that's a link. So you can actually use that link there to click and go to that issue that we last recommended this particular company. Then you'll see the PE, the earnings growth, the risk to reward ratio, the present price, the 52-week high and low are here, the buy below and sell above prices are here, and then there's a graph down at the bottom of the underlying fundamentals. And note that this is a graph that comes from our data service with Morningstar, so it doesn't always represent the data as adjusted by our analysts. And in fact, for extra space storage, where we're looking at funds from operations, this is actually earnings per share. And so the funds from operations has a somewhat different look to it. But again, it gives you a sense of the track record of a particular company as you are reviewing and studying companies throughout the issue and the website. Now we also have a sortable company data table. From any issue, you can click the web link under the company sorts in the right column. So log into an issue, and you'll notice that we've always had that Excel spreadsheet there for the company sorts, but now we have this link that says web. And that, again, should look familiar. It's the same format as the screener results, but this is just an unfiltered list of all of the companies currently covered, which is about 46, 45, 46, 47, something like that, currently covered stocks. And it's the same data that's in each issue and the same data that's in the spreadsheet. We'll be looking to add some additional data to the spreadsheet online, and we'll expand some of that functionality, and that will create some additional screening points as well. So that's something that we'll be hopefully looking at later this year. And so this is the same functionality as the screener results. So you can click on the print button, you can click on the particular company, go to that company profile page. So hopefully those are useful features. We've got other ideas. I'd love to hear feedback on what you might like to see to help supplement your subscription. Some of the features that we have talked about potentially considering would be a simple portfolio tracker or watch list where you could enter the stocks that you're following or you're most interested in, and have a page where you can see perhaps if they have fallen in price. Maybe you thought they were a little expensive when but you still liked them, so you wanted to see if maybe the stock came down a few dollars in price. It might be more attractive to you, so you could have a little watch list going there, or a subscriber-only message board where you could only accessible to subscribers, where you could ask questions, share opinions, and interact with myself and our other analyst, Adam Ritt. So please let us know if you have other information that you'd like to see on the website. If you have some questions, I see Marty says, can the company list be downloaded to Excel? Yeah, the entire company data table is provided in Excel and has been since the start, so you can download that. The screener results cannot be at this point downloaded in Excel format, only printed. You could probably copy and paste. You might be able to finagle it that way. But if you have access to Excel and you have the complete data table in Excel format from the issue, you could probably do some sorting that way and get the same results very quickly using Excel. So we do provide that information in Excel format. So it is in the, if you look at the right column of the subscriber issue section, you'll see the XLS link, and that's the Excel spreadsheet. That's how you know to download that into Excel format. So let's talk now a little bit about small cap market performance over the year to date and the long term. Here we are in the 8th year of a bull market, a very, very long bull market by historical standards. And so how have small caps performed during this period? If we look at the year-to-date performance of the Russell 2000, which is in blue here, compared to the S&P 500, which is in green, you can see that the S&P 500 has performed quite well year to date. It's up 9.7, almost 9.8%, while the Russell 2000 since the middle of the summer has just not been experiencing the same sorts of success, and it's really gotten hammered. It's now up 2.5%. Just a couple of weeks ago, the Russell 2000 was down year to date from where it started. Now it's back up a little bit, so it's got a little bit of gains to it. But of course, that's the near term. I read an article last week that talked about the tendency of the Russell 2000, which is the small cap index, the Russell 2000 to outperform the overall market and large caps in the first 12 months of a bull market, and then tends to trail the bull market for the rest of that period. The problem with that, with all of those studies and historical reviews, is that we don't have experience with bull markets that are quite this long. So all of the data is based on shorter term upticks in the overall market. But that's the general understanding of small cap performance, is that small caps perform best coming out of bear markets. They're the early leaders. They're more nimble. They're able to respond more quickly. Because they're smaller, it doesn't take as much to kind of jumpstart them as the large caps. So it's been spotty the last year, this year, for the Russell 2000. But when you look at the 10-year performance, here you can see it flipped around. The Russell 2000 with 72.7% total return over the last 10 years compared to 60.97% for the S&P 500. This graph shows us a little bit of the correlation of small caps to large caps. It used to be that there was a much higher level of non-correlation between small caps and large caps, and that's largely deteriorated now. Small caps and large caps seem to be moving more in step with each other. In the past, they tended not to grow at the same time. There is still some periods where one will outperform the other for short periods of time, and then they swap places, and you can see a little bit more volatility even on this graph, that when the Russell goes down, it goes down a lot, and then when it goes up a lot, whereas the S&P 500, its gains and losses tend to be somewhat less pronounced. So another way of looking at where we are right now in the small cap markets is to look at the PE ratio of the Russell 2000. The S&P 500 PE ratio is somewhere in the neighborhood of 25, 26 on a trailing earnings basis. But if you go to the FTSE Russell 2000 fact sheet on the Russell website, you'll see the PE of the Russell 2000 listed as 25.58. But if you'll notice, the label on the left says PE X negative earnings. And so it's interesting the way that Russell calculates the PE ratio for its indexes is that they throw out all of the companies that don't have positive earnings. And then they calculate the resulting PE ratio of the average PE ratio of companies that do have positive earnings. Well, for the Russell 2000, roughly a third of the companies in the index are not making money currently, so they are losing money. The Russell 2000 are the 2,000 smallest companies in the 5,000 company database that makes up the broader market indexes. So even with that eliminating some of the tiniest companies from the index, still there's a large number of small cap stocks that are not profitable that are in the index. Last week, or 2 weeks ago rather, Mark Hulbert wrote an article for MarketWatch and where he talked to a financial advisor, a data guy, and who had calculated the PE ratio of the Russell 2000 if you had taken all of the companies' earnings, added them together, and then divided it by the price of all companies. And the Wall Street Journal website actually lists the PE ratio that way. That's how they calculate it. So at the same time as Russell is showing the PE without negative earnings at 25.58, the Russell 2000 is showing the PE ratio as 87.82. So that is a significant difference there, and that is again based on trailing earnings, but that's significantly different than 25. In that article that Mark Hulbert wrote, Vincent Delaird, who was the head of global macro strategy at a firm called International FC Stone, actually looked back at the Russell 2000's true PE at the peak of the 2007 bull market, at the top of the internet bubble in 1999 in the far left, and now at the far right. And so you can see that PE ratio now is much higher than the peak of the internet bubble or the peak of the 2007 bull market. So hard to know how to interpret that, other than to remember that it's a good thing to focus on individual company selection and focus on those opportunities for businesses that are reasonably valued. But if you can't find stocks that are small company stocks that have reasonable valuations right now, this might be one of the reasons. There's just so much capital being deployed in the overall market, and it's lifting up small company stocks, and it's lifting up stocks that have no earnings. I took a look at our small cap informer picks, and the average current PE ratio, so that's the current price divided by the trailing 12-month earnings of the 45 or so companies we track, is 20.5. So that's well below the 25 PE ratio of the overall market, except the overall small cap market without the losers in it. Our average projected earnings per share growth rate is 14.2, average projected total return 16.7%, and our upside downside or reward to risk ratio is 4.2 on average. Obviously, not all of the stocks that we track are what we would consider buys at the current price. They're considered holds, so that brings down our projected growth rates and total return figures in many cases. But you can see there seems to be a lot of opportunity in these stocks that have somewhat lower valuations than the broader market. And that's been our challenge in the small cap informer, is finding stocks that have the growth that we like, but that we don't have to overpay for. And so we end up finding a lot more of what we would consider value opportunities than high growth opportunities. And that's just a function of where we are in the bull market, I think. So from our perspective, it's a challenge, but we are sticking to our methodology as we go through it. So let me segue into a performance update on how we've been doing versus the overall market. Year to date, our picks have been performing quite well. We've had some success with a couple of stocks in particular that have seen some very positive results. So year to date, our compound annual return of all of our picks is about 26% compared to 17.4% for the S&P 500 and 4.8% for the Russell 2000. So this is a benchmarked result. So the assumption is that if you had bought every stock that we recommended, and taken all the dividends in cash, if you would just index that money in an S&P 500 or a Russell 2000 index fund, what would your rate of return be? Since the beginning of 2015, we're also outperforming both of those indexes. We're eking by the S&P 500 9.2 to 9%, but we're outperforming the Russell 2000 by 9.2 to 7.6%. And again, so that's the last 2.5 years where we've found our legs and seem to be moving forward quite well. A lot of our longer-term picks starting to work out, and some of our newer picks have delivered some good results year to date. So that's just a little update. Again, our focus is on the long term, so we really want to focus on getting a 5 to 10 year track record under our belts and continue to identify companies that fit into that framework. So we are patient, and we're going to continue to try to deliver the best opportunities we can in each issue. So a couple of questions here. Bob says that there's an article in the current issue of Money magazine quoting the gloom and doom crowd, Mark Faber, Jim Rogers, etc., that a crash worse than 2008 is imminent due to the market being terribly overpriced. Thoughts, opinions? Well, Bob, that's interesting. I think Jim Cramer this morning or yesterday wrote an article where he recommended that investors focus on everything that's going right in the market as opposed to everything that's going wrong in the market. And if the only thing that's going wrong in the market is that valuations are up, well, there's still a lot that's going well that's supporting the market. From my perspective, the market is doing well for a number of reasons. One, the economy has been continually improving bit by bit since the Great Recession of 2007, 2008. So all of the metrics are showing improvement. Now, they don't improve every month or every quarter. There are always pockets of weakness, but overall, we see a lot of strength in the employment market. We see a lot of strength in the housing market, manufacturing, technology, services. We see growth across the many sectors. We see weakness in some sectors like the restaurant sector, but we see recovery in the energy sector. And so while there are not a lot of growth opportunities that we gravitate towards, we do see improvement there. And so that's helping support this market. I think one of the things one of the factors that's contributed to the growth and the extended bull market that we're in now is that investors have little else that they can go. There's nowhere you can put your money. Investors are not going to the bank. They're not going to CDs where they're getting 1%, 2%, maybe 3%. They're not going to bonds where you can get the yield, but then your principal is at risk. So investors are sticking with the stock market, and that is just boosting returns across the board. Particularly for large cap stocks, because there's just not a lot of volatility in the market, so that creates comfort and opportunity. Traders hate this kind of market where there's so little volatility. It's creating so much fewer opportunities for many traders. They thrive on volatility. So from my perspective, I think that's helping the market along. Many are holding out hope for tax reform, which would potentially boost corporate profits. And we can argue it as much as you want, but just put it out there. That's something that people are holding on to as another validation for current market levels. That's not to say that nothing. It's that we shouldn't be ready for things to turn the other way. I know a lot of investors are holding some cash aside because it's hard to find good opportunities to deploy your capital right now. So kind of intentionally holding money back. In the last couple of years, when we've had corrections in the market, people have stepped in with capital and snapped up those bargains, and that's supported the market as well. And it seems like there's still a lot of cash out there that's ready to be deployed. So I think that's my take on where we are with the market and how we got to this point. Again, in the next 5 years, I fully expect we'll have a recession, we'll have a correction, we'll have perhaps a bear market. We had a bear market in small cap stocks last year. It just didn't last for very long, but small caps were down 20%. And then 6 months later, we're back to where they were. So a very short kind of bear market. For small cap stocks, so where there is a little bit more of that volatility. So that's sort of my my take on it. Again, wherever we are right now in 5 years, things are going to be better. That's my perspective. So I'm going to continue to look for opportunities in the market. As Bob responds, of course, those gloom and doomers have usually been spectacularly wrong. Yeah, I would not be jumping out of the stock market based on anything at this point. I think remaining invested is a wise thing to do. I would just counsel watching the downside a little bit more closely, maybe stopping out some of your big gains and lightening up on positions as they reach overvalued levels. And I know that many people feel like they get burnt when they lighten up on positions that have gone up in value, appeared overvalued, because then those stocks continue to go up in price. But I'd rather be a little more conservative on that and give up a little bit of the gains to reduce some of the overall volatility there. All right, let's. I see some other questions here. Back to just two questions here. Back to the website. The company data that's on the website is always as of the most recent issue, so we don't do interim updates. So Don asks if that information is updated anyway. So the price is there. It all comes from the most recent issue. Christopher asks if there's an easy way to edit the screener criteria, or do you need to re-enter it each time? Right now, there's not a way to save the screen criteria, but we can put that on the feature list and definitely take a look at it right now. All right, let's. I see some other questions, but we're going to take a look at some stocks in a minute, so we can address some of those issues as we go there. I did want to just talk a couple of minutes about some of the stocks. Our August issue is coming out later today, in fact, with a couple of recommendations, but I wanted to call out some of the stocks that have had a lot of action of late, or I think are very interesting. One is Applied Optoelectronics, ticker is AAOI. This is a fiber optic networking product maker. These are products that are used in internet data centers, cable television, fiber to the home, networking end markets. So this is in a world where streaming video and Netflix and people are cutting the cable on their cable television and just going with internet programming. Faster speeds are really in demand, and this is a company that's benefiting from that trend for all sorts of networking components. Beyond that, they've been expanding their margin quite well. They took a hit when they released their last quarterly earnings a couple of weeks ago, because they pre-announced that they expect a somewhat slower third quarter as demand from one of their largest customers was appeared to be softening. Even so, we're still looking for earnings growth of 17%, and the trailing PE is just 15, with an upside-downside ratio of 12 to 1. And the potential for a 29% total return. The stock is up almost 300% since we started covering it. So we really did get in at the right time. But you can see from this graph that that there's a lot of accelerated growth and margin expansion happening there. I've plotted on the analyst expectations for sales and earnings. It's a tiny company at $260 million. It's one of the biggest performers in the month of July and August. It was actually one of the best performing stocks in the Russell 2000 index. But it's dropped down significantly. But even after that decline, I think it's a good opportunity if you can handle the volatility to get into the company, to get into the stock, and establish a position. I just think this is a really interesting company that's going to perform well over the next couple of years. And I think that it got beaten down quite a bit, but it actually puts it right into the buy range at a pretty attractive and conservative level. So I think it's one that you might want to take a look at. If you were kicking yourself for missing it when we first recommended it, I think this is a good opportunity to get in as well. The LCI Industries, formerly Drew Industries, we've covered this a couple of times, and we have recommended it twice in the newsletter. This company makes a broad line of RV components used in both motorhomes as well as fifth wheel trailers. They sell both to manufacturers and in the aftermarket, and they've been aggressively expanding by acquiring other smaller businesses to add to their product line. And they have a goal of increasing the total value of the products, their products that go into the average new RV made in America today. And so on a quarter-by-quarter basis, they're tracking that, and they're actually making a lot of progress there. Positives, there is a very, very, very strong demand for RVs in this country. It's becoming cross-generational. Before, it was seen as something for retirees or for hunters and sportsmen. Now families and couples, empty nesters are all gravitating towards RVs, both the motorhomes and the fifth wheel campers. So companies been aggressively rolling up other product lines into theirs by making acquisitions. Some of them are very innovative. Some of them are not even based in the U.S. And so that's giving them a lot of attractive features and functionalities. Now, of course, the RV makers industry is sensitive to the economy, but LCI seems to be persisting despite any economic headwinds that come their way. We have to be worried about the cost of sales increasing. In the most recent quarter that was just announced, earnings were only up 5%, and there were some significant expense increases that were going on at that point. But the margins have been growing over time, and so I thought, oh, this is probably a good opportunity if you haven't bought this company yet. This kind of slower earnings quarter, I don't think is going to persist, and maybe a good opportunity. And I was thinking about recommending it in this issue, but then I realized we just re-recommended it in April. So it's been on the front burner pretty recently, so I didn't call it out again. You can see the graph here. This is just a really solid, maturing business, $1.6 billion, coming from a mix of organic growth and product acquisitions. It just makes for a really compelling business model in my viewpoint, because they have the sales force in place, so when they add more products to it, it's just easy for those companies to go to the manufacturers and make sales that include more and more components that go into a typical RV. Even with that flattening of growth, prospects are still looking pretty good. The price is closer to its 52-week low than its 52-week high at this point. So we're looking at 15% earnings growth. Trailing PE is 17, again, very attractive. Upside downside ratio 8-to-1, and I think it's a 21% total return candidate from this particular company. Now, again, if we do have a recession, we might see something of a slowdown in earnings, but my guess is it would be not very severe compared to some other businesses, and that they will recover quite well as they go on. And finally, Extra Space Storage is, again, a stock that we've recommended a couple of times. This is a real estate investment trust, so we counsel investment clubs to avoid these because of the accounting complications. But real estate is a great way to diversify a stock portfolio, and REITs are a terrific way to access that real estate sector. Last year, the S&P 500 index broke out real estate from financials and created a new sector, first time in a long time. Our Morningstar data service has always held real estate as its own sector. And then within that, we have real estate investment trusts that serve different types of business models: commercial, medical, residential, mixed, etc. So Extra Space Storage provides self-storage units to individuals and small businesses. They serve a broad geographic area, and they operate both corporate-owned, and they also offer other facilities the ability to tap into Extra Space Storage branding and their information technology systems. So that's another way that they are leveraging their investment in information technology. And that is really a positive for the company, this technological edge that they have. The demand for self-storage is growing, and that there's the opportunity for the company to roll up other facilities. The storage unit space in the country is very fragmented. There are a lot of small operators. There are a lot of mom and pop owned facilities. At some point, Extra Space Storage offers an exit strategy. We'll take over those facilities, upgrade them, brand them, do some cosmetic work, upgrade security, and now all of a sudden it's a premium experience compared to what was offered previously. Now, with real estate investment trust, we look at funds from operations in lieu of earnings per share. That way we take out the non-cash adjustments related to depreciation and amortization. So we're really just talking about cash. So I look at Extra Space Storage and see the prospects for 13% annualized funds from operations growth, and the trailing PF ratio, so that's price to funds from operations, is 18.7. The upside downside ratio, which again I use interchangeably with reward to risk ratio. Dan asked that question. So the upside downside ratio 9.4-to-1, the total return 21.6%, and that includes a present yield of 4%. So I think this is a 4% yield that is pretty secure in terms of the stability of that yield. Many REITs do offer this income component. What I like about Extra Space is that you get both income and total capital appreciation potential, and the PF ratio is a little low, so there's some opportunity for expansion there. My concerns for Extra Space Storage is that this is there's some growing competition in the self-storage space. There is a newer operation called CubeSmart that has a very similar strategy, great marketing, great presence both in cities, in downtown cities and warehouse districts, as well as in the suburbs, good branding, good technology. So that is up at the potential for some headwinds for Extra Space Storage, and of course the very large competitor Public Storage, which has just a significant number of significantly more storage spaces, but I think extra space storage is kind of grabbing more of the mind share of customers, and so I kind of like that as we look at it. Here's what the graph looks like for extra space storage, and again, sales and funds from operations, not earnings per share, and the company guidance there. So you can see what the company is suggesting their funds from operations will be for the full fiscal year. So all on track for that 13% funds from operations growth. And you can see just the annual high and low price is very compressed, not a wide range there. But when you can buy at the low end and the prices come down this year a little bit, I think you have an opportunity over the long term to take advantage of this trend towards self-storage and this particular real estate investment trust. So let me take a look at some of your other questions here. Kim says, is there going to be a recording? And yes, we will. We are recording the webinar, and we will make it available to subscribers for the next 30 days, and then we'll release it to the general public. So you will have the opportunity. You'll get an email that will have the instructions for how to access it. Ken asks, what's my outlook for Duluth Trading? Duluth Trading is a retail apparel store, formerly primarily via a catalog, headquartered in Wisconsin and Minnesota. The company has made a name for itself with very clever product marketing, focusing on this Minnesota, Wisconsin ethos of good quality, not flashy, and catering towards a more working class, but yet people who wanted to not dress like slobs, kind of perspective, and they do it with a sense of humor, and so I think that it's a very interesting retail opportunity. They are now expanding into opening stores that focus on the Duluth Trading, this ethos that they have, and so. Went public last year, so not a whole lot of history to look at. I think that one of the problems is that since they went public, there's a lockup period for a lot of the insiders, and so we expect the price to kind of come down when that lockup expires, and some of the shareholders are able to get rid of some of their shares that they've been have not been able to sell, and that could hurt the market as well for the stock. What I like about Duluth is that it is a unique retail opportunity. It's a unique retail experience. And my thought on retail in an Amazon-dominated world is that if you want to be successful against Amazon and online platforms, you have to be unique in some way. And I think that Duluth can do that. They can deliver that unique experience, whether it's on their own website or in their retail stores, and so I think that gives them a leg up on some other business, and we've seen Sears and JCPenney and Kmart just failing at capturing any sense of the mind share of their customers. There's just nothing unique about that experience, and if you want the lowest possible prices, then you go to Walmart or Target or Kohl's. And each of those have their own brand identity. So I think that Duluth does have potential, but I think it is one of the more speculative stocks that we cover in the newsletter right now. So I wouldn't make it a core holding, but as one of those stocks in the 5 or 10% of your portfolio that you reserve for the more speculative, more interesting, more fun business opportunities, that might be a place for it. Speaking of that Amazon kind of anti-Amazon experience, I think that Five Below is also one of those businesses that is competing in a space where Amazon just can't get to them. Five Below operates a series of stores where everything is priced below $5, and that's the level at which, when you shop on Amazon, they just can't make money selling stuff after you factor in the shipping at that price point. And so I think that Five Below offers a great retail experience. And so that's, again, in the retail space, if you're worried about the impact of Amazon on a lot of different businesses, that's one where I think Amazon is not going to have a big impact, and there's plenty of growth opportunities there. So Jay asks about the Hurricane Harvey in Texas, the impact on businesses there, the impact on the markets. Yeah, there's going to be some impact on the economy in the Houston area for the next couple of years as they rebound. I don't know, and even if I did, probably would not speculate on ways to profit from Hurricane Harvey. We do cover a couple of home builders, LGI Homes and Century Communities, that have operations. LGI does have a couple of communities on the coastal regions of Texas. They're outside of between Houston and the Gulf. So I imagine that they have been affected, but we don't have word yet on how much those communities might have been hit by the market. But that's why both those businesses have communities across the country in different regions that provides geographic diversification. So I'm not terribly worried about the impact of the storm on those companies in particular. It may actually benefit them in some ways if people choose to move inland to a different community that they operate. It could help boost prices over the next 12, 18 months or something like that. But from my perspective, there's nothing permanent that we have to worry about. Their exposure is limited compared to their overall geographic mix. So I'm not worried, and am not really concerned at all about those particular home builders in that area. I think the home building sector is one we have to watch very carefully. Both those companies have been subject to lots of campaigns suggesting that home building stocks are a bad place to be putting your money, and they both have performed quite well over the last 6 months, the last year, and I think it makes sense to include them in your portfolio. Yes, if we have a recession, they're gonna take a hit. People don't buy new homes at the same rate during recessions as they do during expansions. So we could see a little bit of a fall off then. But I'm not counting on having a recession anytime soon. And any recession we do have, I'm not counting on it being particularly hard or particularly long. So that's why I like to be a little contrarian and have been looking at that housing market. Also, Essent Financial, which makes private mortgage insurance. Again, if you were convinced that the market was going to crash, we were going to go into recession, the economy was falling apart, you would not be in any of those companies in that particular sector. But I think they performed well for us, and I think there's a lot of upside ahead for those particular companies. So Dan asks, is extra space storage appropriate for an IRA? I think so. Because they're paying distributions, those distributions do not qualify as qualified dividends, even if you were. So they're going to be taxed at any rate. So put them in your IRA, and then you don't have to worry about the taxation part of it. That can be a good practice. Now, REITs in general don't pay corporate income taxes as long as they distribute their earnings to shareholders at a high level. So they're avoiding taxes there. So one of the opportunities where you don't have to worry about double taxation is by investing in REITs. But yeah, I wouldn't hold off on putting a REIT in your IRA. Virginia asks, what are the prospects for Hennessy Advisors? They've been falling or sitting still. Yeah, Hennessy has been rolling up by acquiring some other businesses, some other mutual fund businesses. Hennessy Advisors runs mutual funds. And so during bull markets, we see a lot of capital going into those funds. We see assets under management growing. When we have a bear market, we see the market turning around and pulling money out of their mutual funds. And so these mutual fund companies like Hennessy Advisors can take a beating. Yeah, they've been treading water for the last couple of quarters, even though results have come in fairly strong and fairly consistent. Their CEO still sees a lot of opportunity in the bull market for the next year or so, and so we think, again, I think it's got a lot going for it. It's a small business, but they're growing quite well by adding to their business and executing with the funds that they do have. So I think there are opportunities for Hennessy, but as always, it can be difficult. There's not a lot of analyst coverage, and it's a small company stock that just doesn't get a lot of love from Wall Street. But the fundamentals still appear to be really strong for Hennessy. Linda says, what about electric cars' impact on energy stocks? Well, that's a tough question, and I don't know that there's any particular way that we can play it. Just remember that electric cars do still require and utilize fossil fuels to generate the electricity that charges their batteries. So they're just kind of swapping out there. Yes, they are more efficient. Yes, instead of gasoline, they can rely on coal or nuclear, solar, or wind-powered to charge them. It's clear we're in a paradigm shift in the U.S. in the energy sector as solar and wind power alternative sources come online and have been disrupting the traditional sources. I think we still have a long way to go before we see a complete electrified vehicle army in the U.S. I'm all for electric cars. Tesla is the second largest car maker in the world by market cap, but last year they made 70,000 cars. So there's a long way to go. The Nissan and Chevy electric vehicles have not, again, are not taking over the highways either. So I have no doubt that in the next decade things are going to change quite a bit. Some of the plays that we've had, some of the stocks like Luxoft Holding does IT and software development on a speculative basis, or on a hired basis rather, for companies that are working on autonomous driving, and that's also kind of a part of the whole movement towards electric cars. And so I think that there's some other opportunities there. But beyond that, the oil companies are still enormous, and their products are used at phenomenal rates every day. So it's not something that's going to go away anytime soon. And so that's my take on it. All right, well, I think that wraps it up. I think I've addressed most of the questions that have come in. So we're going to wrap it up here. I want to thank you all for coming to our webinar. Please use my email. Give me feedback. Let me know what you like about the newsletter, what we could do better, what you'd like to see on the website, or new features in the newsletter. And let me know if you like this webinar format. We'll look forward to doing another year-end webinar. My plan is to do a couple of these a year just for subscribers to help you get access to get questions answered and learn about what's going on, make the most of your subscription. If they're popular, we could end up doing some more. So please feel free to give me your feedback. And thanks again for being a subscriber. We really appreciate your support and hope that you're able to find opportunities in the small cap market that will help you and your portfolio to grow and reach your financial objectives. So thanks again. We'll see you next time.